Good afternoon, team. All right, stocks recovering at the end of the day today. Real turnaround there. I'm going to go through mortgage rates today, just barely hanging on to the range that we've been talking about. We've been discussing this, how important it is for us to stay in this range if we are going to stabilize. We've seen some stability here recently. We've seen a little bit back and forth. We've seen a little bit of the hand being given to buyers here in this market, which is great. This is especially good if you're a VA buyer. Right now, go ahead, get in the game.
Yeah!
It's time. It's time. If you've been sidelined as a VA buyer because you're like, this is just too crazy for me, no one will look at our VA offers. It's time to get in there. It's time to get in there right now. So these moments of weakness or uncertainty in the market where people a lot of people just step to the side and don't do anything. They just sit and watch. And those are usually the times where you can gain by taking action. So let's keep that in mind for buyers here looking at this. Obviously, this is the interest rate chart. Derrick Evans here, VA home loan specialist. NMLS is 155010. You can tell I'm an OGLO because my NMLS is only 6 numbers. That's what's up. Text me, call me, send me an email if you want to buy or refi. Let's get into this sucker. We'll look at mortgage rates first. Well, we're going to look at mortgage bonds. Then we're going to go through a few stories, and we're going to look at mortgage rates. We're going to go through rates today and just see we're hanging on. I mean, the VA high balance rate, hanging on to the 4s. I mean, we're just clinging on there, just doing everything we can, even though it feels like
it is your destiny.
Rates are going to get worse. It feels like it. It looks like it in the charts. But we're sitting here saying a little prayer because, it is possible this former support level here, which became resistance and made this new range, is hanging on. It's hanging on. Oh, look at that. We're right on it. Wicked under it today. We wicked under it today, but pull back up. We did pull back up. So down 23 basis points today. We'll see what rates look like. Obviously, this downtrend is never ending. It hates us, and it wants to destroy our businesses.
Hated it!
Is what it is. But at the end of the day, this trend line here will break. It's just a matter of when. Is it this week? This month? Next year? We don't know. But at some point, this will round out. And the more time we can spend consolidating, the better. So the less just straight down that's going on, the better. Okay? So while this doesn't look good, it doesn't. We are still in the range. Okay? The range has held. This range is still safe. And as long as that's the case, I'm going to be optimistic. It helps. It helps. Stability is good, especially in a situation like this. Okay, let's go through a couple things that are in the news. Stocks recovered today at the end of the day. We're down pretty much all day. And the very end of the day, we got to run up in light volume. So that, to me, is usually how head fakes happen. Now, that said, stocks have been down quite a bit. We've been talking about this for months. I've expected more downside than this in stocks, but we haven't seen, I don't think, the worst of it yet. That said, feels like a head fake. We'll see what happens tomorrow. Oil up $105. Gold's really taking a dip. 1863 now, below 1900. Crypto, we're not going to look at too much today. Bitcoin now in the high 30s area, just kind of hanging around that $38,000 to $39,000 space. And a lot of altcoins look like they've already been through a bear market. XRP, ADA, all those things kind of look like a bear market already happened. So hopefully there isn't a bear market on the precipice or yeah.
Check, please.
So a Fed mistake. I saw this talked about a lot today. And we have the Fed is going to announce a rate hike this week. And we're expecting 25 basis points, which is what they have said that it would be, right? And we've also heard 50 basis points. We've heard some Fed governors say 75 basis points. We don't know for sure what it's going to be. What does the market appear to be, pricing in? It appears the market is pricing in a more aggressive move, maybe 50 basis points. Here's the highlights. Markets expect the Federal Reserve on Wednesday to announce a 0.5 percentage point increase to benchmark rate. So 50 basis points, kind of where everyone's expecting it to be, even though they only declared 25 basis points. Fears are growing over how aggressive the central bank will have to be to tame inflation. That is why we saw the sell-off on Friday. Inflation's really bad. You need, the Fed should be very aggressive in combating inflation, and so far they've been they're acting like the academics that they are, and that they have all the time in the world. And if we don't fix it this quarter, we'll do it next quarter. We don't have that kind of time, you dingbats. We don't have it. There's not enough time to do that. We don't have the time to sit around and figure it out in hindsight. You need to take action. You need to pull the freaking trigger. You need to do it sooner versus later. A recession at this stage is almost inevitable. Okay, this is what people are saying. This is a former Fed vice chair. Recession, it's hard to say that a recession, everyone wants to think that I've never seen so many people predict a recession before, which pretty much means one can't happen. In order for a recession to take place, we would need to see a couple of things. Well, we have seen the negative GDP, but you still have a lot of job openings. You still have, record household wealth. You still have so many things that are so good, and there really isn't a lot of threat to them. So I don't know if recession happens. It's not going to be any time very soon. And so maybe this is why the Fed has been holding out. I'm not sure, but this is a decent one. Check out this article and let's see what happens this week. I think that the more likely thing, as far as the Fed making a mistake, being too slow, is that they would get the first reading that inflation is looking okay, and then immediately about face. Hopefully they won't do that. Hopefully they will stay the course, but we've got a lot of time before we can see that happen. And this is one that a lot of people are going to see today, because home affordability is in a rough spot. Just the cost of owning a home pretty much everywhere has gone up so much that we've seen now that the actual average of home affordability nationwide is nearly, not the worst, but nearly the worst on record, as mortgage rates have gone up. We've talked about this. Mortgage rates have gone up over 2% since the beginning of the year. And there's just, there's housing costs. It's not just buying a home, it's housing costs. Rents are sky high. Home prices are up. Interest rates are up. This is causing a lot of strain. The question that we're trying to answer is, will that trickle down into other things? For example, if I have to pay $400 a month more for my mortgage, does that mean that I'm now going to cancel Netflix and, water delivery? Or, is there a trickle down to this? Because everyone who's telling you that the market's going to crash, everyone who's telling you that there's going to be a recession, that's pretty much what it is they're banking on, is that the rise in costs for homes and for other goods, other necessary goods like gas, are going to be big enough that they cause people to stop spending on certain things and therefore start to recoil the economy. And the GDP number being negative would make some of those people take a victory lap. Although it doesn't seem to me personally like that's what's going on. People are very creative these days, and work from home has caused a lot of people to be able to dodge this gas bullet. So I don't know. I don't know if that really has as much of an impact as people might think, but housing costs for sure do, because people will make those decisions. They'll buy smaller cars. They'll sell one of their 3 cars, if there's one they don't need. They'll sell toys. They won't buy a toy that they were planning on buying. Those things can happen, but it's really hard to see the effect of that, and it doesn't happen right away. It would take a long time. I mean, at least a year or two for us to really see the impact of that. So if you're wanting a crash, or you're calling a crash, or you're calling a recession soon, I still don't see it. It's just not there. 10-year Treasury yield, 3%. Now, you tell me, when does that start to get sexy as an investor? I mean, when you start to look at that and go, you know what? Why do I have my money in the damn bank earning 0.2%? Should we just buy some 10-year treasuries for 3%? And then, maybe if they become even more and more popular, maybe we could sell some and just take a capital appreciation approach instead of a yield approach. I don't know. It's interesting. It's an interesting situation that makes me want to buy. I'm not a bond trader. I'm not. But it makes me want to buy these treasuries with cash for two reasons. Number one, I'll take my 3% guaranteed, right? I like that. I'll take that. Give me that. Or maybe bonds rally. Maybe, and not just, I'm looking at the mortgage bond chart here, but maybe bonds rally and rates go down. Then what? Then I sell my bonds I bought at 102 for 105 and take a quick 3% on the whole shebang. That's how you trade bonds. I'm not a bond trader, but might have to become one. If yields keep going up, I'm telling you, at some point, it starts to get sexy for, big money funds. Now, I'm not a market mover. I'm a grain of sand in the beach. But, for the big market movers, starting to see 3%, 4% money from the govy, that starts to look pretty good. That starts to look really good, especially if you have cash on the sidelines or if the stock market's taking a ding. I don't know. I'm not calling the bottom here on rates, but I'm just telling you, it's starting to get there where it starts to look pretty good. How much in student loan debt can Biden forgive? Here's what's on the table. A lot of people are asking me about this. A lot of people have really strong opinions about this. This is one of the most distraction-oriented topics out there right now that really has very little impact on anything, all except for, and this is why I stay quiet about it, I guess, if they do forgive all the student loan debt, they would help the economy tremendously. I mean, it really would. You have people who are completely riddled by this. They can't buy homes. They can't buy cars. They can't really do anything because they have $1,500 a month in student loan payments or $2,500 a month in student loan payments. Making $80,000 a year. That's everything. That's it. That's all you've got. So, there's a lot of people who are strapped like that. There's a lot of people who are making very small payments on their student loans. They'll never pay them off, ever. So if they did wipe them, it'd be great for the economy. Although, to me, it seems like a lame move. The real burden here on student debt should be on the universities. The universities should have some sort of accountability to, hey, if we sold you a degree for this much, you should be able to make the money back in X amount of years. Otherwise, you should be able to apply to have the debt discharged and paid for by the university themselves. Plain and simple. There should be some process for that. Or, get rid of federal student loans altogether. Let it be a private sector situation, and then just make those dischargeable in bankruptcy. Plain and simple. That way, if somebody hits a bad spot, they can BK this debt. You can't BK student loan debt. It is the closest thing we have to a debtor's prison in our society. So, yeah, something needs to change there. I don't think forgiving it is the right move, but that's what a lot of people are talking about. We'll see. So this stagflation is a word that you're going to start to hear. What does that mean? How does it play into things? Basically, stagflation just means that the price of everything is still going up, even though we don't have growth. So technically, right now, we are in stagflation because we have a negative GDP and we do have high inflation numbers. And that sort of combination is really, it's weird. It's just a bizarre place to be where, things are going up and getting more and more expensive, but there's no growth happening, which means wages will obviously eventually plateau and start to decline, but yet everything's getting more expensive. And so you get to certain points where stuff just doesn't connect anymore. And you'll start to see holes in different parts of different businesses in the economy. And it's not pretty. It's not pretty. It'd be like a bacterial infection, just not good. It's going to eat this, eat that, screw that up, screw this up, throw your balance off. It's just something that isn't good. It's not good. And that's kind of where we're at. So if you have inflation with growth, you can kind of survive, right? It makes sense because you have increasing wages. People are okay with it. They understand, oh, yeah, well, things are getting better. My 401k has gone up. My income's gone up. Of course, the price of homes should go up. Of course, the price of cars should be higher. But when it's like, wait a minute, rates are up, my wages are down, and the price of a car is more expensive, the price of a house is more expensive, that would be stagflation. And so that is what the real big concern is. I'm not going to talk too much about that one. We're not going to look at that chart either. We're going to look at rates today. So I'm going to go ahead and just start firing this up. And the reason, we got a question here. Tanner says, what's the difference between 4.5 to say 2.0 and 3.5 MBS, for example? Well, those are just the coupon rates. So that's sort of the starting point. So if you have a 4% starting rate That's at the price of 100. That's how much yield you would get, 4%. And then as the price goes up, people buy that 4% bond. They buy it up to 101, 102, 103. Then the yield goes down on it. So you could technically buy a 4% bond if you bought it at the wrong time, and buy a 3% bond at the right time and have a higher yield, which sounds weird, but it is what it is. All right, we're going to look at VA here. Keep things simple. We're using 780 credit. We're going to go, we're going to start with conforming balance. So under 647,200. And we're doing detached on all of these. And we're doing no lender fees as well. And so we're just going to kind of see where rates are at going across the board. 4.625. If you have some time, you can do a CMG. If you needed to go quick, you go UWM and get what? 4.875. 4.75 for $509 isn't the end of the world. So, yeah, that's not bad at all. So you got a couple options there. We always look at this, hey, we have a quick option, we have a slower option. CMG is better rates, but a slower option. United Wholesale, faster option, not quite as sharp pricing. Flagstar, you use for situations here and there, pretty much when you don't have any other choice. Sorry, Flagstar. And then, but they've been there. They've been needed. All right. So safely under 5% for conforming balance VA. Now let's take the journey. Take the journey up to high balance town. This is anything above 647,200. So if you bought a house if the purchase price was 700,000 and you're putting 100,000 down, you'd have a conforming balance because your loan amount will only be 600. So it's all about the loan amount. And so this is going to be high balance VA. Same situation. This also hanging on to the fours by a thread today. By a thread, $179 thread. Just trying to stay in the fours. And I appreciate that. I really, really do. Because at some point, most likely, all of these rates are going to start with a 5 or a 6. That's the most likely scenario. I know I talked about, last week how this could be a rounding about. This is sort of a rounding scenario here. Maybe it's, it sort of flattens. Usually the rounding sort of looks like that. Okay. It could be there. It could be in. We could have all this stuff already priced in. People are calling, the sell-off on Friday in the stock market as a bottoming motion. People are calling that right now. I don't know what chart they're looking at, but that's what they're calling. We could have that happening in rates, although I don't think it's going to be the case. So I don't want anyone to get too excited about that. All right, so VA, we're safely in the fours. Let's check out FHA. Now with FHA, keep in mind, if you're up in Riverside County, or really anywhere, but Riverside County is just such a tricky one for FHA. I think it's 562, 750 is the max loan amount up there. So this loan wouldn't technically work in Riverside. Always got to check your county. Riverside's just a weird one because they don't have a high balance limit for FHA. I have no idea why they would do that to y'all. I'm really sorry that's what's happened up there, but it kind of is what it is. So let's see. We're going to start with conforming balance first. And right in the same spot, 4.625. If you got time. And really, 4.625 for $300 if you don't. UWM coming in there. Now let's look at high balance FHA. And you'll notice if you've been watching us do these rate videos, we have seen rates sort of worse than this, right? And we've seen sort of a stability here. Like this should start to be normalized. Are those, and that's a good question to ask yourself if you've been watching these. Do those numbers look normal? Do they look normal? All right, let's see. 24,4,772. Got it. All right, high balance FHA. Let's see where we stand. And by the way, if anybody just has one credit score, you have 3 bureaus. If you only have one score, for some reason you don't have much credit and whatnot, there is a loan for you. We have one to fire. Yeah. See, look at this. Flagstar is the best one here. Although I would tell you, I would go with Penny if it were me. But, depends on the situation. If it's a 30-day escrow, I feel okay doing Flagstar. Wow. Look at that. Look how weird that is. Not a par rate on the board. Interesting. $16 to get 5.125 with Penny. And you can get the 4.625 with Flagstar. That's just dramatically better. I mean, if you look at that, the second best one was a 5.125 at par, and that's $12,000 in closing costs here. You see, isn't that interesting? Banks just don't have the same stuff. Like, they're all different on different days. They want different things. They have different margins. They're coming off a bad quarter, coming off a good quarter, having to make up for lost revenue, having extra revenue to play with, being more competitive. There's so many different things that can happen. I mean, look at the difference between that. That is absolutely remarkable. I want to say this one more time in case anyone just didn't get it. So Flagstar here, this high balance FHA scenario, 4.625 was par. And what we did was we went down here and looked at the next best one, which is PennyMac. They didn't really have a par rate, but the closest thing they had was 5.125. Cost $16 to get it, so pretty much par. 5.125 up here with Flagstar, $12,000 in lender credits towards your closing costs. That's paying for your closing costs, y'all. Exactly.
Damn!
I know. So this is why it's great to be a broker. All right, let's go to conventional, and then we're going to do jumbo as well. There's one thing I will say is there's jumbo programs coming out of the woodworks, and they really are good. There truly is some really good jumbo product out there, especially in the ARM space, lower down payment. That's the closest thing that we have to subprime this cycle is just call it portfolio jumbos, which we haven't had in a long time. The jumbo market is usually more stringent than like conventional, and it seems to be loosening a little bit. Okay. So we're starting conventional, high balance conventional, so $800,000 purchase price, 5% down. We always do minimum down just to keep it all the same. Flagstar again is up here, 5.875 at the same rate. Definitely United Wholesale will be the way to go. 5.875. Yeah, you get 5.75 for $1,000. That's probably worth it, right? Drops the payment, $61. Yeah, that's worth it. So I would go 5.75. Spend $1,000 there. So high fives. This is high balance. Let's see what happens when we take her down to conforming balance, which is any loan amount under $647,200. And the reason why I do this live like this is because I just want it to be as authentic as possible. I know you don't like it, probably watching me do data entry, but if you want to know what's real. And I don't know what these are. I haven't gone through and done this exact same thing ahead of time. So conforming balance. So we have this bank, CIT, historically known as one of the most difficult, just horrible banks
Hated it.
to work with ever. But look at the pricing on this thing. It's wild. 5% with a nice lender credit on this deal. That's a conforming balance, conventional loan. Look at that. Oh, man, you can even get into the fours for only $285. So they have something good there. You do need a longer escrow, and you do need a squeaky clean borrower like W-2. I wouldn't put any tax returns through that thing. But if you start looking at like fast banks, man, it gets tough. I mean, you get down here, there's Loan Depot, PRMG, PennyMac. I mean, I'm just trying to give like a real fair assessment. 5.5. Let's call it 5.375, somewhere in there if you need to do a quick escrow. So still low fives. So high fives for high balance conventional, low fives for conforming balance. Now let's do a jumbo scenario. What's an easy one for me math wise? Let's do 1.5 million. Let's just make the math as easy as possible for me. So 1.5 million, we're going to do 20% down. And then we're going to do one, we're going to play with it a little bit and see if we can get it 5% down or 10% down. We'll play with that for a second here. Okay. So 1.5, a little blah. I'm going to take off the fees in checkbox. We're going to still look at it, but just because that can eliminate some possibilities in the jumbo space, so we're just going to kind of take that off, but just factor it in. Okay, so yeah, so JMac is way up there. We have a fixed comp on that one, which always makes it super sharp. So you 5%. Look at that, fixed on a jumbo, 20% down. Isn't that wild? So United Wholesale has this Prime Jumbo Flex Max whatever titanium alloy that they've got, and they've got 5.25 for UWM. That's a jumbo. So you can do a Prime Jumbo with UWM there, 20% down, 5.25. You can close that thing as fast as you can close anything. That's pretty cool. Okay, so let's call it 5 to 5.25. So jumbo rates effectively better than the high balance conventionals because the LLPAs are crushing the conventionals. Let's for funsies, let's put this in an arm and just see what happens. Let's see, is it 5-year arm or 7-year arm? Let's just put it at 7-year and just see what happens. What in the world? Look at this. This is what I'm talking about. Look at CIT, 7-year arm, 3.85. Good Lord. And you go to 3.825 for $300. You need a longer escrow. You need a squeaky clean borrower for that one. Let's do JMac here, more realistic, 4.5 on a 7-year arm, jumbo. It's not bad. I mean, you can get the fixed for 5.25. You can come down here and realistically get the 4.5 with a little lender credit. Actually, no, we have lender fees to cover. So yeah, there's about $500 in lender fees there to pay. But 4.5%, that is not bad at all. Not too shabby. That's fun stuff. Okay, we'll do one more. No, that's enough. That's enough. We've seen enough at this point. Here's what I'm looking at. Tomorrow, the big deal is going to be, can mortgage bonds bounce off of whatever it is that happened today? Whatever is going on to make stocks rally last second, all this stuff, Fed meeting this week. Can we stay in this range? Can we break up higher? I feel like we need some room. We need to move higher. That's really what I'm paying attention to, because breaking this and getting down here, closing down here and creating new candles down here is just more of what we don't need, which is rates continuing to go up. My biggest concern this entire time has been how much will rates go up and how quickly will they go up, because speed is also going to play a factor here. When someone, I saw a pre-approval letter someone sent me. They said, oh, here's my pre-approval from my previous lender. It was only like a month old, and the rate was, over 1% less than what they could get today. So when things happen that fast, or people are in the shopping process, and this is all just happening, working against them, the sentiment element of that is bad. It creates negative sentiment, which is tough to combat. It's hard to look at reality when you're in the middle of something like that. It's hard to step back and look at it objectively. But, if we can have a little more stabilization, if we can keep stabilized for a little while, you get everyone out in the market accustomed to and understanding of what rates are right now. Because there's still buyers out there right now who probably haven't been briefed about how much rates have gone up. There's still buyers probably writing offers who don't even know what their rate or payment would actually be. Believe me, this happens. Not with my people. That's for damn sure, but it does happen. So if we can get that completely flushed out, some of these escrows we've seen recently, I talked about it in my last video, where they go in and then come right out. And they're like, no. Those are people who just didn't calculate their payments before they got into escrow. They've just been so programmed and so used to just go look at homes, write offers, go look at homes, write offers, get denied. Go look at homes, write offers, get denied. They finally get accepted, and they go, oh, wait, okay, what do we do now? Oh, let's figure out, what's the payment going to be? Oh my God. Oh, Lord. And they just want nothing to do with it.
Check, please.
So those folks need to exit the market, stage left, and the people who are understanding of what the market is today, those will become our people, and that will be the real market. But if rates keep going up, we're going to have to keep combating this. So that's the reason why stabilization of rates is so important. All right, I'm going to get back to work. You guys have a great day. Give me a call. Shoot me a text if you need me. I'll be here for you. NMLS 155010. The call text number 619-952-2046. Have a great night.